Education Center on tdameritrade.com.
When traders tell us how to make Thinkorswim even better, we listen. Like Jack. He wanted a streamlined version he could access anywhere, no download necessary. And Kim. She wanted to execute a preset trade strategy in seconds. So we gave him Thinkorswim Web. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim by TD Ameritrade.
Good afternoon. Welcome to the Watch List. I'm Nicole Petalides, 2 p.m. Eastern Time, live at the New York Stock Exchange, waiting on the Fed minutes. Those are imminent. Right now are seeing the Dow down about 120 points, but obviously the markets have been in somewhat of a wait-and-see mode. The S&P at 44.48, the Dow at 34,296. Both are to the downside, while the Nasdaq squeeze out a gain here of 15,215, and the Russell is down 0.9% at 1880. We do have a 3-day win. Stocks have been strong, or at least a win streak, I should say, for the Dow and the S&P after a fabulous first quarter for stocks overall, and the Nasdaq in particular. U.S. dollar is gaining 0.25% at 102.96. Gold pulls back 0.1%. Oil gaining 3%. The volatility index has been right now at 1411, and Bitcoin futures still above 30,835. In the meantime, waiting on these Fed minutes, I bring in here for the markets and the latest reaction to Ben Lichtenstein.
down. All of it amounted to, or seemed to amount to, the case for hiking, and yet at the end of the day they decide to wait. I was hoping for some clarity on why they were waiting. I think Daniel has an interesting thesis here. I'm not sure I 100% buy it, but it's a good thesis that they're more worried about recession than perhaps they're letting on. But I do think they are going to hike in July. I think the groundwork has been laid for that hike, and I also think it's entirely possible they're going to move on to hike again in the next after one more skip. I think they're in perhaps this pattern here of every other meeting. They want to get the rate back up. I don't see, by the way, much change at all in the probabilities for November is the meeting we're looking at. It's still about a 35%, 36% chance of a hike, and there's still a strong, 85, a little bit higher now, percent probability of a hike in July. So I do think they are going to hike in July. I think they're going to hike again, maybe later this year if they don't get a big change in the inflation and in the jobs numbers.
So that being said, if there are more hikes to come, where do you see opportunities? Do you still think that there's room in market equities, or do you think that investors need to look elsewhere?
Well, I guess thinking of other asset classes or geographies, I mean, certainly we're cautious on the outlook for the U.S. and for Europe. And in the U.S., certainly it's with the strong returns we know we've had this year in particular. So we say unbalanced returns, so dependent on tech. We don't feel comfortable with that. So actually we are underweight U.S. equities and looking to emerging markets instead. Because even if I'm right that it is a slowdown and not a recession, I mean, it's still a slowdown. So that's going to be a drag for equities.
And so when you're looking at geographies, do you think of emerging markets as opportunities, China as an opportunity?
Emerging EM Asia in general, and I think there's two distinct components in that, because I think we appreciate now we're not going to get the spillover that we hope to for China to the rest of EM Asia. But if you look at how EM has done overall so far this year, it's been very tech-led, so a lot like the U.S. So it's been Korea, it's been Taiwan, and we still think that's an opportunity. China, we think clearly sentiment not been very helpful so far this year, but the earnings projections at least are quite good, and if those earnings come through, the markets have got to reflect
As
that.
you look ahead to 2024, what do you expect the interest rate picture to be? Lower or higher for longer?
If the Fed is patient, shall we say, about getting inflation down quickly, that implies the higher for longer. You know, inflation's not going to fall quickly, so rates aren't going to fall quickly.
Higher longer.
But a year from now, I think for one way or the other, you're going to have rates lower. Either it's because inflation has fallen, so the Fed can lower rates, or you do get the recession and they cut. So in a sense, the fixed income call is a bit the easier one because you really should have lower rates next year. Equities, a bit more challenging.
On that note, Daniel, we shall leave it. Thank you very much for your insights. We appreciate it. Steve Leisman, thank you as well, my friend. Appreciate it.
Let's take a look at how those bond yields are moving after the release of the Fed minutes. The 10-year yield rising throughout the day, 3.93% right now. You can see the yield on the 10-year note, and the 2-year yield also rising higher for most of the day, but pulling back when the minutes came out, right around 4.93%. Coming up, America's chess match with China continues. Xi meeting with Modi and Putin for a virtual summit not long after.
Yeah, I think that the Fed has to continue to talk tough and continue to put in our heads that they're going to keep rates higher for longer and to not expect rate decreases anytime soon. They've definitely said that. And so with that, we are also expecting at least one more rate hike, maybe in July. And then the question is, will there be one also later in the year? But I think keeping the expectation that rates are going to be higher for longer while we try to get back down to that 2% target, which Powell has made clear is going to take quite a while. He doesn't think it's going to happen, in fact, until 2025, which would mean keeping rates restrictive for longer until we see the effects of the economy slowing, which in fact leads us into the most probable scenario, which is going into recession later this year.
Right, understood. And that's what a lot of people are talking about, the recessionary environment that could occur. And that is part of the risk that is evident. However, that the market has in fact maybe bottomed. I mean, what say you? Can the economy dip into a mild recession, which is the word they used as what they see as a possibility, a mild recession, and not go back to those lows that we saw back in October?
It certainly could, Nicole. However, when we're looking at earnings per share expectations going forward, and what's been priced into the market is a pretty robust 2024 and 2025. So if we start seeing analysts keep revising downward on expectations, then there would be a repricing in the markets. And I think that is the greatest risk, is that there still could be more downward pressure on consensus with earnings per share. And if that happens, then we'll see markets adjust accordingly. And I think the biggest area of the markets that could adjust is in the technology space, which has grown so substantially once again, so that if we continue to have higher interest rates for longer, and then we have consensus expectations being revised, we could see some of that decline.
Right, understood. So when we talk about asset allocation, is there anything that you would be doing to adjust a bit? People often look at their books quarterly, or people who trade more often will look more often. But is there anything you might be doing here?
Yes, after 2 great quarters in the market, we have been rebalancing portfolios so that we take advantage of the gains that we've had so far this year, and specifically looking at small cap, which has rallied, and now looking to pair off some of that. And then also, declining areas like consumer discretionary, where we feel
workers. We'll give you the details when Power Lunch returns.
So you'd authorize, $100 a month for the ship to come out every month, and that would be on chain and trackable and paid in real time, and Visa would have some control there to settle disputes and whatnot. So they are always leading the charge here in the payment and really in the banking sector as well.
Right. So this blockchain-based payment solution, when you talk about other countries and having it go across countries, do you see that even growing more so? Not just for Visa, but for, I guess, so many types of, whether it's credit cards or fintech?
Absolutely. Payments are always a huge deal, and global payments are even a bigger deal. So anybody who's trying to send money, whether it's friends and family or business contractors overseas, it's very difficult. And to go through the different levels of the banking system can be tough. So the technology is there to do it on blockchain right now. It's more a matter of some of the big players using their leverage to start to force through these efficiencies. And Visa's indicated a willingness to do that.
Right, understood. And it's not just the finance sector. I mean, you talked about Maersk and the supply chain sector. Explain that.
Yeah, logistics is another very natural sector that people are always waiting for it to years, where a couple big companies like Maersk and IBM launch a joint venture to launch a logistics blockchain, and it's called TradeLens. And they signed up a ton of big customers, had a ton of traction, and then all of a sudden it just kind of stopped. And they actually just discontinued it recently. And so it goes to show that not everybody's got the power to push this through. Visa maybe can from the top down, but Maersk was unable to do so. So for example, in the logistics sector, there's a company called Venturis, and what they do is they track new vehicles. They can tell you, they put the GPS location and timestamp it and put it right on the blockchain. So you know exactly when it leaves a port, arrives in a country, and that's helpful for insurance, for risk management, for transfer of title, for a number of things. And so while they aren't publicly traded, once they want to scale, they're going to need to find somebody who has that expertise. So although a company like Maersk may not have been super successful with their first launch, they now have that expertise that I think is going to play a big role in the future as we see some of these logistics companies now grow from the ground up.
Right. And really, when you think about blockchain and all this data and the way it happens, I mean, it sounds like it could benefit pretty much any company, anywhere, any style. But healthcare, the sector there, you said a name like Pfizer benefits from this technology.
Yeah, so Pfizer, absolutely. They jumped in originally with something called Project AdApp, which ironically was also trying to manage the supply chain a little bit better. So everybody wants their supply chain improved a little bit, especially over the last several years. But the
Dolly Lenz, Jenny Lenz will talk to us about what's been going on in the housing market, what's hot, what's not. What about a crash? What was that all about? Is that a thing even left over? It's now summer. Where do we stand? Let's ask Dolly Lenz and Jenny Lenz next.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you an active trader? Our active trading webcast series is designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
I'm Nicole Petalides coming to you live from the New York Stock Exchange every single market day from the opening to closing bells. Tune in to the TD Ameritrade Network.
When traders tell us how to make Thinkorswim even better, we listen. Like Jack. He wanted a streamlined version he could access anywhere, no download necessary. And Kim. She wanted to execute a preset trade strategy in seconds. So we gave him Thinkorswim Web. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim by TD Ameritrade.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs, and the next wave of tech.
And that's where we come in, discussing strategies and example trades on trending names.
Take control of your financial future. Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade Network.
Welcome back to the Watch List. I'm Nicole Petalides. Time to talk about real estate. Joining me right now are the pros, Dolly Lenz, CEO of Dolly Lenz Real Estate, and Jenny Lenz, Managing Director of Dolly Lenz Real Estate. Thank you both for being with us. So, can we start off with New York City, Manhattan? It's great to see you both. Just capped off an historic month. How so?
Well, New York City saw the second highest June ever in number of luxury sales, which is crazy, right? We're supposed to be having a recession. We're supposed to be having super high interest rates. They seem not to be able to kill the buyer, right? The buyers are out there, they're flapping their wings, and they're grabbing onto property. They can't seem to kill it.
Right. There was a record 29 contracts signed in June, which is just crazy since I think it was 2006. That's a record. So still the market's hot. Mortgage rates are so high, right? A 20-year high at 7.17% for 30-year fixed. And, you know, still buyers are there. And we're doing a lot of deals going to New York, back and forth from New York and Florida for the most part, and, you know, following the client, and things are looking good.
I mean, for real estate brokers are looking, but for sellers are looking.
Yeah. Let me jump in here and ask the question, who's buying? If they're able to sell these luxury, you're seeing the luxury sales at the second highest ever for this month of June, the number of sales. A, who's buying, and are the prices significantly lower than a year ago, or are they, you know, where are the price point to?
That's a great question. So the prices are somewhat lower in general, right? So if we track, you know, apples to apples, a specific apartment sold a year or two ago for X, it's now being resold for a little less, but it's only a little less. That doesn't include transaction costs, which may make it a lot less, but still, it's shockingly strong. And there's still bidding wars, right? If an apartment comes on the market priced well, several people are after it and are bidding for it. That is still going on. And the buyers are the usual suspects: doctors, lawyers, investment bankers, private equity guys, VC people, entrepreneurs, and somebody who just sold another house somewhere else and needs a home, so has money because they're already in the market.
Right, and they might have a little bit less competition because there are people that are fearful of the high interest rates. Even our wealthiest clients, they want to make the spread on the mortgage rate and what they can make. So some people are out of the market, but still things are selling, and they're selling just below what the records were that, they doubled.
Because we know that Florida has been working on instituting some sort of parameters about foreign buyers and how much they can buy and such. I'm sure some of these buyers are foreign buyers, and if you have anything to add to that, that's fine. I mean, I'm not an expert on that, but I would like to talk about the mortgage rates, which you touched on. They're off their highs, but they had trickled higher during the month of June, near the end of the month, right? But that didn't deter folks.
It didn't deter them at all. And in terms of foreign buyers, so, right, Florida's been a little quashed on that by, 7 countries being watched and whatnot. That's obviously going to put a pause on those buyers. They don't really want to jump in while that's going on, even if they can get around it, which they generally can get around it. But New York has had a lot of foreign buyers. So summertime is a great time for a foreign buyer. They're coming into New York. They're here from China. They're here from London. They're here from Paris. I know what's going on in Paris. They're here from all over the world, and they're buying property actively.
Right. Things look great. It's green. It's not the winter where things are looking terrible, depressing.
Yeah, exactly.
And they are here and they are buying. So obviously good for us, good for our sellers. And next year, we don't really foresee anything to change. Maybe pricing will come down a bit, a couple percent. A lot of economists are predicting that. But, we see the same thing for next year. Hopefully mortgage rates come down a little so that, that first-time home buyer can step on the property ladder. But we see the same thing pretty much going forward.
Yes, and it's just crazy that they literally just, again, can't kill the buyer.
One time we spoke, not the last time, but the time before that, you came with a list, and it was, I don't want to say gloom and doom, but it was more
What role does competition for Tesla play in your skepticism?
Minimal. I think Tesla has a great future. From an institutional investor perspective, I look at the stock trading at 45 times my 25 numbers when I'm, factoring in 20-ish% EPS growth. I am willing to, put somewhat of a retail investor hat on and stretch the multiple because that's the type of investor base that's here. But 45 times for a 20% EPS growth, it just doesn't seem as great a fit for me at this point in time versus Rivian.
What little I know about investing tells me that when you've got a PE that is more than double the growth rate, that is a very expensive stock. You ideally, don't you want a PE that is either in line with or even below the growth rate of the stock, right, Chris?
That's Tesla's never traded at a cheap PE to growth, what they call a PEG ratio, but that's kind of to me, you're pitching the case for Rivian back to me. You've got a stock where investor expectations are low, things are turning around, and investors aren't on the train yet, versus Tesla, you've got a stock that the train is quite crowded. It's already left the station and it's trading at a very expensive multiple, and expectations are high for Cybertruck. Expectations are high around this charging standard in the United States. So the bar is just higher to own the stock in my eyes.
Chris, thanks very much. We appreciate it. Chris Pierce.
What little you know about investing?
What little I know. If you check
watch
my portfolio.
Call me skeptical. Coming up, model behavior. The FTC taking a hard look at franchising, including whether it's fair to individual owners and their workers. Do parent companies hold too much power? We'll explore. Plus, taking a walk. UPS and the Teamsters Union at a stalemate in contract talks. Each side now.
You pay $1,100 a week to have your pool serviced. It's just insanity. And that's going to keep most people out of the Hamptons, right? And they're finding other great alternatives. Good for them. Other secondary home places, So whether it's wintering or summering, right, we're using all verbs here. Florida is hot as hot could be. I don't think it could get any hotter. The little bit of inventory that's on the market seems to be scooped up immediately. And Jersey Shore, very hot, oddly, right? So it's not like the Hamptons. The Jersey Shore is very strong market, rental and sale.
And when it comes to the Hamptons as well, I think people are still always thinking about COVID, right? And still wanting to travel and do other things, and not necessarily like when I was growing up, go to the Hamptons June, July, and August, park your kids there, right? They're still wanting to travel. And when they're traveling and talking to all their friends, they're also exploring, like Dolly said, into other areas that are much cheaper. So I think the Hamptons is going to have problems in the future holding up those prices, especially if they don't get the rentals, right? Because the rentals do speak to the prices. You're getting $100,000 for June because your house is worth $10 million. If you're not getting $100,000 for June, then, that does speak to the price of the home.
Yeah, exactly.
Got it. And this limited inventory is keeping housing alive, so we don't have to worry about a crash at the moment, according to what you've said and what we've seen. That's just really the situation. Thank you.
The only issue with the crash really is that people, if they don't make their mortgage payments, right, in some parts of the country, we're seeing that, right? There's a few more of those people on watch lists of not paying their mortgages. If those go under, then obviously there's going to be a problem.
Right. Thank you both. Wonderful to see you both always, Dolly and Jenny. Really appreciate you coming on always. It's always a great conversation. Dolly Lenz, Jenny Lenz of Dolly Lenz Real Estate. Thank you for being here on the show. Still ahead in the next half of our show, we're taking a closer look at ETF trends. Bitcoin, tech, where do those fit in for 2023? We know they've been winners so far. Now what? As we head to break, take a look at winners and losers in the S&P 500.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Thinkorswim by TD Ameritrade is more than a trading platform. It's an entire trading experience. With innovation that lets you customize interfaces, charts, and orders to your style of trading. Personalized education to expand your perspective, and a dedicated trade desk of expert-level support that will push you to be even better.
prices had come down, so that was good too. All right, Caroline Woods, thank you so much. Now let's turn our attention to the ETF market, focusing on this as we begin the second half of 2023, taking a look at these trends. Aniket Ulal, VP, ETF Data and Analytics at CFRA. Thank you for being with us. So are ETFs really still so popular the way they've been? How do you quantify this?
ETFs still continue to be popular, though certainly we haven't seen the inflows this year that we've seen in past years. The primary explanation for that is money market funds soaked in a lot of assets, took in a lot of assets this year. But as a product structure, ETFs continue to be popular. They've certainly taken a lot of share from mutual funds. In the first half of this year, ETFs have taken in just over about $200 billion. That's a fairly significant number, again, less than last year, but fairly significant. And we've seen a turnaround in this year itself. The first quarter was really weak, but the second quarter was much stronger. And we've seen active ETFs, in other words, ETFs not linked to an index, really be one of the strongest segments of the ETF space, taking in almost $40 billion. So overall, it's been still healthy growth, but not as strong as last year or even as expected at the beginning of the year.
For example, tech has really led the way overall, right? And that has been the case for ETFs too. Have you seen a lot of interest? Are people taking profits?
We've definitely seen interest. As you know, flows tend to lag performance. When I was in your show, the last time we talked a lot about money moving into defensive strategies. We talked about gold. We talked about quality. Now that performance has been strong for a while, ETF flows are catching up. So investors are moving much more into tech, into growth-oriented strategies, much more than they were in early in the quarter. And as you mentioned, tech and growth-oriented stocks have been one of the stories of this year. If you look at from an ETF perspective, the technology sector, Spiders, is up 40%. ARK, which tends to be a bellwether for growth stocks, is up about 43% this year. And that performance has certainly led to some investors moving back into more offensive risk-on type strategies, as opposed to where we were even a couple of months ago.
I wonder, too, if the way the market behaved in 2022 spooks folks, and if they had a particular equity or whatever and they got hit hard, maybe that's why they like ETFs, because they're a little more broad-based, right? You're not all your eggs in one basket.
That's absolutely true. I mean, ETFs, even though there are now much more concentrated ETFs available, in general, the assets tend to sit in funds that are much more diversified, low cost, and you're taking on less risk, as you said, compared to individual equities. Of course, you may be giving up upside in particular names, but overall, it's certainly a more broad-based, diversified way of investing, while still being able to express views on particular sectors and themes. I think that's benefited ETFs. The other thing that's benefited ETFs is the ability to move into products that either, for example, defined outcome ETFs, where you can cap your upside, or move into quality-oriented ETFs. So there's a more range of options now available than just the traditional beta type products. And I think that's also benefited the product structure.
Right, understood. And at this point now, with rates, you might see the Fed still raising rates. Where does that fit in? Because there are actually bond funds too. When you talked about thematic investing, I mean, there's Bitcoin, right? You talked about tech. You had XLK. I mean, just what seemed to be the hottest themes?
Well, as you said, the Fed has signaled that we may have even one or two rate hikes still to go here. But I think investors appear to be looking a little bit beyond that. We've certainly seen investors on the fixed income side take on a little